Hey, good afternoon. Welcome. This is TakeStock Live. Today's date is Thursday, January 21st, one day after the historic inauguration of Joe Biden. I am your host for the next 35-40 minutes or so, Sam Evans. TakeStock is brought to you and powered by stockability.com. We are here every single week at noon Eastern Time, 5 p.m. UK time. I always like to mention UK time because you probably tell by the accent by now. I am a Brit, so here I am. So it's great to have you here on the show, as always, as well. We've got a fun show, a short, powerful show, I think is exactly what we're going to describe this one at right now as well. We are live here on Facebook Live, so please feel free to type in your comments as we go. Love to get your live questions coming through and happy to answer those questions as they actually happen in real time. Also, this show is recorded and also is going to be available here on the Stockability Facebook page. Also, we are going to be restreaming and playing the recorded version of this on the Stockability YouTube channel as well. Well, I hope you've had a good week so far. Let's take a look at where we're at right now. Had a monstrous day in the market. What's the best thing to do? Well, before we go any further, let's actually talk about the news that's really driving the market today. According to the press right now, yesterday we had record closes on the Dow Jones and the S&P. Brand new highs were made. The market was going into the day hopeful today that we were going to get another record day high, but typically these things don't move in a straight line, as many of us know. And so at the end of the day here we are, kind of a lackluster day. Right now S&P trading at 384.95, just around the $385 mark right now on the S&P. We'll go through the current numbers when we pull up the charts in just a second on here as well. Jobless claims fall but remain elevated. Okay, so it's good-ish, bad-ish, who knows, it's kind of really the same as always at the end of the day, you know. What can we say about this current economy? A lot of uncertainty hangs in the balance as well, and none of this helps. The quarterly earnings have started now. Earnings season is upon us as well. So we've got Dow Components, Intel and IBM out with quarterly results after the closing bell today. So they're two of the big ones here, Intel and IBM. My question will be, how much are we going to start to see the impact of the new M1 chips in Apple's new Macs versus obviously what we've seen with Intel being the powerhouse behind their processors and chipsets in the past? Are we going to see in this quarterly announcement? I very much doubt it, but it will be interesting to see how that thing works out in the coming weeks as well. Biden details 10 executive orders to fight COVID. I think off the top of my head from reading the press yesterday, Joe Biden had the largest amount of executive orders ever put out on a first day. I mean, good for you, Joe. You're busy. You've been waiting long enough, a century in the political, half a century, should I say, 50 years in the political game and finally president as well. Good luck to you, sir. I hope you do the country proud as well. I always remain politically neutral on this show and generally in my day-to-day life. Whoever's running the office, it's not a job I would want. Good luck to you. I hope it all works out well for the American people and the world as well. Everyone is looking and we wish you well success and support on there as well. And also the newly Democrat-controlled Senate does now get to work as well, with now the Democrats having that majority as well. I hope it is not the end of balances and checks, so that's just one of the things I will say on here. It'll be an interesting time to see just how effectual Biden can be in this presidency as well. Just noticed that 5 million vaccines have been administered now to people in the UK as well, so they're getting those vaccines out, which is great. Again, I think that's the word on the street right now. Everyone really looking at, where is the market going? Where is it taking us? What's happening with the virus? That's really the thing. We're still hearing about mutant strains and so on. I feel like since I started this show, well, I guess that's what happens. You start a show in the middle of a pandemic. Probably one of the things you're going to be talking about a lot is the pandemic. But how does it relate to the market itself? That has been the question for a lot of us on here as well. We'll find out more about that, and I'd love to actually bring on my guest in a little bit as well, Ryan Watkins, and I'm going to get his opinion on that too as well. But before we bring on my guest, Ryan Watkins, to talk about, knowing when to be a trader and when to be an investor, let's just slide over to those charts and see where we are. Just doing a little kind of recap for you right now. As I said, S&P 500, kind of a lackluster day we can see on here on the market. We've had a bit of an up. We did push out another high at 384.95. That is the high. But on the day, we're up 0.04%. Just 13 cents and change just right now on the market. Not really a whole lot to get too excited about. How's the QQQs? The tech sector had a powerful day yesterday. Oh my gosh, what a day did we see on the tech sector yesterday. Indexes, look at the powerful day we had yesterday. Markets closing around 324.77 yesterday, or just under that. Today, a brand new high, but in place at 326.37. Again, we're seeing that doji forming on the day right now, about halfway through the trading day at the moment. Be interesting to see how that pans out for the rest of the day right now. But again, following suit with those indexes. If you're brand new to the show, you'll find typically with the indexes, they pretty much all do the same thing generally. And notice I say generally there because generally means most of the time, not all the time. There are no such thing as certainties in these markets. The Dow Jones, the DIA, let's go over to the diamonds right now. Take a look at where that thing is at the moment. Again, not quite as much of a powerhouse today as the others on here, but we will see. Oh man, look at those charts going a little bit crazy for me right now. Let's just zoom into this part here and see where we're at. You can see 312.71 was your high put in on the Dow Jones today as well. Very lackluster. The market we've all been looking at from an index perspective though has been the IWM, or also known as the Russell. Okay, now interesting that this is something we talk about a lot. Not a great day on the Russell. As you may know, the Russell has been the powerhouse when it comes to these markets. If we go and actually take a look at the Russell here, let's go over to a weekly chart. Guys, just look at the price action of this over the last few weeks. There's nothing to stop the Russell on its onward trajectory. I mean, the move that we've seen to the upside on this has been crazy. But again, selling pressure coming in around that $2,000 mark, $215 on the ETF price right now as well. I've been saying it for weeks. I'll say it again. This thing does need a correction. It's having good days. But man, I do not want to be putting my life savings into that as well. Like anything, waiting for the pullbacks. The uptrends do seem still to be in place. And we will respect that, and we will make sure that we honour that as well and play that. I'm not here to call a top in the market. There's a lot of year left to go. We will find out how that works and what the market's going to be come of it. But again, definitely that one. You'll find this when some of these markets push higher at a faster rate. They're typically always the ones that come down. Big shout out to you, Phil Jackson. Glad you're watching here on the show right now. Good to have you here, my friend. So let's just look at some of the other markets that are powering on today. Some of our favourites that we have on here. AAPL, Apple on the day on there as well. Apple fighting against the grain right now, the broad markets as well. Making another charge on here. Good, strong open today. Big, powerful. We call this a propulsion gap on the market. Closed lower yesterday. Massive gap up. Gotta say, looking at this chart right now, there is really not a lot to stop this going higher and potentially testing these previous highs at 138 and 79 for me. Love to know that. Again, I would not want to be on the wrong side of that. Holding its support levels consistently every single day. And again, here we go right now. I do remain bullish. We took out some key weekly areas just before. No reason to see if this thing doesn't knock on the door of 138. I wouldn't even be surprised to see this thing get up to maybe around the 140 mark in the coming weeks as well. Apple definitely still a powerhouse. Going to be interesting to see their earnings since introducing the Apple One subscription model. I'm a subscriber, Apple, if you're listening. I love it. Apple One, Fitness Plus, movies, all of the stuff. You know, love it. Absolutely. The arcade, great thing for $30 a month. And I don't work for Apple, but I think, you know, heading into that, going into that subscription model that they've done has really solidified them as an overall lifestyle company. I look at with Apple as well. What else are we going to be looking at? Let's take a quick look at some of the other major markets as well. Always like to take a little bit of a look at gold, oil, and also treasuries right now. Gold has not really been doing much for me lately. Again, looking at this on the daily charts, to me, it has been drifting. We see this downward trend on gold, but it keeps bouncing back. The big numbers for me have been around this area here, 1800 to 1775. Mark it off on your box there. 1800 is really the number for me. 1800 is really the number for me as well, but struggling. It seems to have plateaued a little bit here, but again, while we're holding 1800, a lot of open gaps that I'm seeing specifically around here. I gotta say to myself, $1,900, 1925 seems to be on the cards right now. While we're holding this nice level of support right now, the market is still trying to push higher, and I think with the uncertainty that we're seeing in the market right now, people aren't going to be running away from gold, but they're not also going to be piling into it. I feel there are a lot of bulls still out there who still see plenty of upside in the market before the next correction. Gold is a great way to hedge it. So we're probably not seeing all of the money going into gold, but we're seeing just enough of it going in just to keep that propped up as well, and a little bit of smart profit taking along the way, which we've seen in the past. A little bit of smart profit taking seen around these key levels here around the 1950 mark, where that selling pressure came into the market as well. That is your gold market on here. While we're on the subject of commodities, a lot of you will know on the show that I have been very bullish on the crude oil market. Let's go take a look at crude oil. $55 was my call. Let's see where we're at right now. 53 and change is where we're at. Let's just do a zoom in and look at this recent price action. I've had students I've been working with right now looking for short trades on this. I've been advising against it. To me, this trend is still strong. For me, again, looking at these recent highs, just shy of 54. When we look at this market, and I'd like to go into a slightly larger time frame, what I see is some resistance around here that we do have to get through. But with the new buyers stepping in, 50 seems to be the new benchmark here. I got to eyeball 60, and if I'm going to be a conservative man, I'm going to be looking around $68, $70 over the coming weeks on that as well. Again, maybe people buying up. Demand is on the increase right now, prepping for the reopening of the global economy. Oil ain't going anywhere. Transportation ain't going anywhere. My way of looking at this is to say to myself, maybe the big commercials, and the commercials are a huge part of this, guys. Commercials are maybe loading up on the oil market here. I remain bullish on it right now. Might be a great way to be playing, I don't know, the options on the crude oil ETF or small size on the futures as well. But a little bit of interest in oil for me does go a long way. $60, maybe 65 could be where we're looking for on that. Finally, let's just go look at treasuries and then we can see what we got on here. Code on the futures. I like to look at the futures market. If you're unfamiliar with a lot of these as well, the futures market for me is the best representation of it. It's a nice, easy way of looking at it. 136,295 right now. You'll see on here, on the weekly charts I've got. I'm going to go back over to the daily charts. Well, actually, let me show you the monthlies. I mean, look, talk about overbought. I mean, you look at this chart, and we are so overbought, but the trend is still steady. There is a ton, and I mean it, guys, there is a ton of wide open space below here, and I keep eyeballing this support area around this 129.40 area, but again, the market's still holding up. Before we get to that, there's a few other areas, but the selling pressure is there. Literally 1, 2, 3, 4, maybe 5 months in a row of downward pressure on treasuries. As you know, as the market's going down, that's it's kind of a subtle clue that maybe interest rates will go up. I can't see anybody raising interest rates anytime soon. More for this, if this does push down, it's not because they're going to be of economic policy. It's more, again, flight to quality. People putting their money in government bonds to protect because of uncertainty in the overall stock market. Maybe it's just something as simple as that. I don't know. But again, I remain a little bit bearish on that, and I wouldn't be surprised to see us dropping down a little bit lower to this 139.19 at the moment. Again, teasing those lows, making new lows, but not doing any really significant closes. The pressure is there, though, guys. No real major support for a little bit. I do see treasuries drifting onto the downside a little bit. Maybe a few people will prop them up along the way, but again, nothing more than profit taking to me as well. Hey, Jana Joyce, good to see you on the show as well. All right, guys, well, that's the markets as a whole. That's my quick recap of everything of where we've been today and what we've been doing on here. What I'd love to do is now just get back on over to talk about, obviously, our topic of the show. Now we've done our market recap. And to do that, I'd love to bring my guest. He was my guest on the show last week. He's my guest on the show again this week. I guess I love working with him so much. I just had to bring him back on. There he is, Mr. Ryan Watkins. How are you, sir?
I'm great. How you doing, Sam?
Fantastic. And you're coming through loud and clear. Last week,
Good.
that booming voice of yours, we were having a little bit of sound difficulty. But I see you are registering loud and clear on here. How's your week been for you so far, my friend?
Oh, it's been great. It's been really good.
What you been up to? You've been teaching, or you've been taking a little bit of time just to kind of
Yeah, teaching a course on income abilities.
Nice.
And, really we're focused on looking at trades that produce an income. So day trading, swing trading predominantly, something where people can capture some money, some revenue on their trade, whether it be a day trade or swing trade, and use that as to either for an income, either part-time income, full-time income, supplemental income, or maybe they just want to grow their account, not necessarily for income, taking a paycheck type of income, but more like revenue for their trading business.
Nice.
Either way.
Nice. Because I think it's interesting, isn't it? Because a lot of people, when they first get into the markets, they have that one single pot of money and, their money's in it, and then they buy cash positions in stocks. And they don't realize that, you're going to take that route. That is the longer term game, more of an investing game as well. You're focusing more on what you're talking about, your teaching is more the income side of this as well. So, is the stock market the best place for that, or there are other vehicles that, you tend to focus on for that, Ryan?
It's interesting because I started out in the stock market doing exactly that, the short-term day trading, swing trading using stocks. And I think it's actually a pretty good way to start out, to learn this business. It's not a bad way to go. But, fast forward to present day, one of the things I've learned is leverage helps. Leverage helps. You get a lot more bang for the buck, and leverage can cut both ways. So if you don't know how to use that leverage, it could hurt you, by losing money. And so you need to know how to manage your risk on every trade. And as long as you know how to do that, position size correctly, use your stop losses and things like that, you're fine. Leverage isn't something to be scared of. It's something to be used
It is a
and to
double-edged
be
sword,
used
though, isn't it?
properly. Let me
Yeah.
emphasize.
Yeah, I mean, it is a double-edged sword, though, isn't it, as
Right,
well? I
right.
think people need to remember that. I mean, I think what I love about leverage is it allows somebody to play the game, as I call it, who didn't think that they could play the game, you know, who didn't
Right.
even think they could get into the stadium. You know, because, I mean, realistically in today's world, I mean, let's just pull up a chart and say, for example, you know, when you look at the stocks, and this ties in beautifully to the subject of today's show as well. If I just go over to the charts right now, let's take a look at, you know, a favorite, AMZN, Amazon, okay? We'll look at some charts of that long term. And I'll just bring up here the daily charts right now so we can all see that. And let's just zoom in here. You know, you look at Amazon right now, and if anybody at home can't see this, let me just zoom in for you. Right now, that stock's trading at $3,310 per share. Now, I don't think Amazon's going anywhere. And I will say this, I look at this chart and I see this whole area here around 3,100 has been a major support zone where there's been a lot of interested parties buying. But my question, I guess, even though it was cheaper at 3,100, how many, you know, to buy 100 shares of that, that's a lot of bang. That's a lot of money you need. And, you know, this is the thing I find it can be really, really deflating for a lot of people is that they look at these big stocks and it's great. Yeah, they go up. But the problem is how much can they really participate? You got to put $3,000 into just one share, Ryan, you know. Do you find that's a common problem with the students that when they're looking at the stock market to try and invest these days?
I do. They look at something like that and just say, hey, that's just too expensive. That's not my game, you know, and they got to go somewhere else. And I look at it and say, well, look, you can still trade it with using options, for example, for a fraction of the cost, and you can still participate in all the return on investment. And so it's a great solution. And so using different trading vehicles is one tool in our toolbox that us traders get to use. You know, you got options, you got futures, you got Forex, you know, the stock market, and stocks do have leverage. It's just not a lot. You know, you're capped at a 4-to-1 leverage. And that's only for day trading. If you're doing overnight trading like swing and position trading, you're capped at 2-to-1 leverage. So yes, you get leverage. It's just not much.
Yeah, you pay because even now, if you're getting 4-to-1 leverage, you can only hold that within the hours of 9:30 to 4, and then what you're
Right.
paying about $800 a share still.
Yeah.
You know, you need a big account to participate. And again, even when you look at some of the other favourites, you know, some of my favourites, like I say, that have been phenomenal as of late. Let's go on over to another one. One of my plays I've been very bullish on is Disney, okay? In the long term, I might add, you know, Disney, definitely bullish on that in the long term as well. $170 a share. The average person on here, you know, say you're buying 1,000 shares, that's $170,000 they've got to put down, right? If you want to buy 100 shares, that's still $17,000. I guess my question would be, if you've got $17,000, you know, and you're willing to buy 100 shares of Disney, could that $17,000 be utilized in a much safer and more effective way somewhere else, Ryan?
I believe so.
Yeah.
That's what I would do, sure. You know, and it's something where I guess, you know, coming from a stock background, I've done that for many, almost 3 decades now, really. And there are some good things about stocks, and I still will trade them a little bit in the right situation. But in a case like this, for example, with Disney, it just makes so much more sense to use options on Disney. You get a lot more bang for the buck, and also better risk management, in my opinion anyway. Using options, you have a lot more flexibility, you know, when you're using different option strategies to get the upside, you know, potential profit on that, you know, return on investment, but at the same time managing your risk in a much more effective and efficient way than just, say, you know, putting a stop loss on there, which is fine too, but there's just better ways, you know.
Of course. While you were talking, I brought up Ford. Okay, and you know, let's just go through a couple of charts here of Ford. Let's just start this here on the monthly perspective. And I mean, when you look at this, you know, just from in the last 6-7 years, you know, where this market's been. I mean, look at the steady downtrend. We've had a bit of a rise. I remember one of my students talking to me about this just before Christmas, about, you know, where we were at, and I was actually very bullish on Ford. You know, with the students, Nancy, if you're listening, you'll know it's you, Nancy Lenz. You brought it to my attention, and we were looking at buying on Ford right now. It looks amazing, right? Because it was, look here, Ryan, $4 a share, roughly, right, at the start of last year. Now you're at 2. So people look at that and go, well, look, I could afford that. But then I suppose, you load up the boat at $4 a share on that, and then you put so much money into it that then if the thing literally, like here's the thing, you say, well, I'll go buy, 10,000 shares of Ford. I'll put a big chunk of my IRA into Ford. I'll buy 10,000 shares. I'll put 40 grand into it. And then suddenly it goes down to $2 a share. You've lost half your money. There's just as much danger almost when things are too cheap. Wouldn't you agree? It's great when they do that.
Stocks are cheap for a reason, right? So, you get a situation like Ford, and I remember, I would monitor this from time to time, and I just saw that massive downtrend there on the left side of that chart, and it's just no thanks. I'm not going to buy that thing. And even when it did have that really strong rally recently there, it's just not something that I participate in. I don't like to buy cheap stocks unless there's some really great reason. And it's got to be a great reason for it,
But on here, you buy 10,000 shares of it down here, and you have to excuse my writing on here, but 40 grand investment is now worth $120,000 investment. And people look at that, and it's always easy to say I coulda, woulda, shoulda, right?
Yeah.
But again, as I say to people, that $40,000 investment, if that thing would have dropped literally $2, which isn't a lot, that's suddenly a $20,000 investment,
Yeah.
And that's the danger of those cash positions. One of the ways we were looking at it, Ryan, was saying, what about buying the call options on Ford? And actually, that was the play that we were looking at. And the volume was there to buy the calls, and our risk is a lot more limited on the thing. We can use it a lot more effectively and then take that punt. And I like to, look, I don't mind having a punt, Ryan. I don't mind saying, this thing's real cheap. Are Ford going to go out of business? No. And it could easily double money very quickly, but I'm going to do it in a safe way. I guess I look at it like this. I love to scuba dive. I tend to wear like an oxygen tank because I want to do it safely, right? I rock climb. I use a rope. If I want to participate in a move like this, if I believe, on a move like this, that there is that upside potential for it, there's better ways to go like an option, right? We could also do it in that respect too. So, again, everybody look at those, it's about doing it the right way. It's about a balance, this seems to me, Ryan. Talking about this with you, it all just seems to be, this is all about balance at the end of the day. And, one of the topics I wanted to cover on the show is, when do we know to be a trader and when do we know to be an investor? We've opened the show pretty hard and fast here, and I think we've been really talking about that. One could look at that and say, for me, Ford could be an investment long term, right? But I'm not dangerous. Or it could be seen as, but there's better investments. That's a whole nother subject. What is a good long-term play and what's a bad long-term play? Going back to Disney, I think that's a great long-term play. I'd rather have Disney than Ford, let's put it that way, right? I'd rather have, be a little bit more invested in tech with the way it's going. But again, if you actually look at the markets right now, and again, I want to look at, say, like, the overall stock indexes. Let's go over to the QQQs for just a second. And what I'd love to do is just pull this up on a daily chart. And again, get your opinion on this. I think that this really it tells a story. We've had this upside, but nothing lasts forever, right? And I guess the question is, if I hone in and I really look at where we are right now, Ryan, okay, let's wear my investor hat. And I'm just going to use the QQQs, just text as a whole right now. This is a question where I could ask you, does it really make sense to be a long-term investor now? That's the question I've got for you, being where we are.
No. Nor is it a long-term, or I should say, let me rephrase this. With my own money and the accounts that I manage, I would not buy the NASDAQ right now.
Mm-hmm.
It is extended. It is high. Think of it this way. If this was a dance move, right? We got 2 or 3 steps forward, 1 step back. 2 or 3 steps forward, 1 step back. And right now, you got about 4 steps forward.
Yeah.
And it's like, okay, we need that step or 2 back now.
Yeah, like this, right?
And that's where I'm waiting. So if you actually, that same exact chart that you have on there, go back 1, 2, about 3 days, that red candle.
Yeah, right here.
Right there. So that's the step back I'm talking about.
Yeah.
So I bought there, I loaded up on various options positions, and then the next candle, the blue candle up, and you got another one, and then today. So I'm out of almost all those positions right now. Just that one little swing trade, like 2-3 days, boom, done, out. So that's an example of a trade.
That is just what I say. You wouldn't class that as an investment. So you're using a vehicle that you could invest in, but you were trading it for 3 days, right? 3 days.
Right.
And your reasoning for that, Ryan, tell us all that. Your reasoning for that.
Opportunity. It's a short-term opportunity.
Right.
Is really what it comes down to. A short-term opportunity, because, and I really do, and I've used this example in class, like the dancing stuff, right? And I'm no dancer. I'm telling you that right now. I did it. I took a dance class once before my wife and I got married, so we could dance on our wedding, and that's it. So, but in the lessons, the instructor was saying, 2 steps forward, 1 step back, or whatever it was, And I remember telling my wife about this. I'm like, hey, this is kind of like the market where we go 2 or 3 steps forward, the market goes up, 2 or 3 days, and then it comes back a day or two, and that's just the rhythm that these markets dance in, And so really all I'm doing is dancing with the market. I'm finding where is that 1 or 2 steps back. That's where I want to buy. Now that could be using options. It could be buying a stock. It could be a futures or a Forex, whatever it may be, whatever vehicle that is. But I'm looking to buy that step or 2 back to get the next 2 or 3 or 4 steps forward. And so in that particular opportunity on the NASDAQ, that was my shorter term trade on that. Now, longer term trades, I don't have any longer term trades that I initiated, right then. Those were done long ago at much lower prices. But let's just say that didn't happen for a moment. Let's just say I'm a brand new investor and I put $100,000 into account. What do I do with it? I don't want to just buy right now. I still want to wait for an opportunity. I still want to wait for the opportunity to present itself in that form of a pullback. Because one of the things that I hate the most is buying the high. Been there,
like now,
done
you
that.
mean, all right? Like,
Been there, done that.
Like right now,
Yeah.
I mean, you buy right now, where we are right now, we're buying the high. I mean, there
Right.
is literally no doubt about it. No doubt about it.
And the thing is, let's say tomorrow, what if price goes even higher? Yeah, it's a possibility, right? So what if, we're high right now, but it could go higher, and markets do, they go higher. So if that's the situation, that's where I'd say, okay, as an investor, I'm still not going to buy because it's not the price that I want to buy it at. I want that pullback to happen, and then I'll start loading up on the investment side of it. However, as a trader, now I can go in with a scalpel and a microscope and say, where is the opportunity on some of these lower time intervals? Now, that might be a day trade. That might be a swing trade. I don't know yet because, the market hasn't shown its hand yet on that trade setup. But as far as an investor, the trade is not right now. So, you asked the question, when to be an investor, when to be a trader. I think a lot of this comes down to the person themselves. What are they really trying to accomplish? If they just want to invest and they don't want to trade, that's a whole different question then, because you don't have to worry about the trading. Like, that's done.
Right.
You're just focused on, okay, I want to invest. What is the best investment that I can find? And then what is the best price that I can realistically buy at for that really good investment? So that's a whole nother topic right there. So really, I think people just have to understand their situation and say, am I an investor or am I a trader or am I a mixture of both? Personally, I am a mixture of both. I do short-term trading for the quick hitting opportunities that happen, more frequently. But then on the investment side, it's longer term. I'm still looking for a good price to buy.
Sure.
Still looking for a good product to buy. And then it's just simply, okay, let the thing play out over the course of months or years.
I like that.
And then on the other side of this is more of, and this now I'm going to talk about the assets that I manage for other people for a moment, because that's a little bit different, is that what are some really great products or assets that can be purchased for that particular account in the right mix. Okay, so for example, what I will do with that is do what's called tactical asset allocation. I'll give you an example here. Let's say, for example, we were just talking about the Qs. Let's say the Qs has a big 20% pullback. It really drops hard. Okay. Most people would say, oh my goodness, it had a 20% drop. I'm scared. I don't want to buy. I start salivating on my keyboard because it's like, this is the time to buy when people are panicking, when they're afraid, when you see this big drop in the market. This is where you want to start loading up, because in my mind, I'm thinking, hey, this is going to last 5-10 years or longer. Maybe it's a 30-year trade for someone younger, And so I'm getting in at a really great price. It's a 20% off sale. Like when the COVID crash happened, it was a 30 to 40% off sale on a lot of these markets. And so that is when I said, hey, here we go. I'm going to sell some of the stuff that's making money and then rebalance and buy the the thing that's gotten beat up, the thing that's a 50% off sale or 40 or 30, depending on what it was. And I know when I buy there, it's for the long run on this thing.
Yes.
It's not going to be some short little 3-day trade.
Right.
Although I did that too
Yeah.
for the,
Well,
the shorter term stuff, for the shorter term account.
It's
but for the
when to
longer term,
switch
it's
gears.
a great place to get in and buy.
Yeah, and it's knowing when to switch gears, right? It's mixing it up
Right.
to complete. I mean, look, I'm a simple man. I always look at it with analogies, right? So with exercise and things, you can do all your weight training, but you need to do your cardio work, keep your heart and lungs done. If you just do all your cardio work, you don't then have the muscle and the strength. So it's about a balance between that, those two things. So, again, I guess it would be a fair assumption to say then that in your world, it could be that, hey, I've got this long-term position that's going long-term. And then, I'm playing, other things around it as well for the short term, I guess that makes it very much, you don't really care what goes on, right? I mean, or do you have preference to the trading or a preference to the investing? Do you have a preference?
Right, it's not too much. I mean, if I had to say a preference, I would prefer obviously that the equity markets go higher and higher because that's healthier for the economy and the world, So, but I realize that, hey, that doesn't always happen. We have crashes, we have economic situations where you're going to have large declines, 10, 20, 30, 40%, whatever it may be. And we as traders need to be opportunistic that says when we get these big steep pullbacks, we need to be ready and fearless. That's a whole nother issue there. It's not just being prepared to buy when the markets are having their dip, their pullback, but being able to go in there without these negative emotions affecting us so that we're too scared to go in and buy.
Yes.
And for example, I've had situations where the markets have come down and I've bought and I didn't buy the exact low. Right. Imagine that.
Right.
So it's actually sometimes gone down a little bit lower. I'm like, I didn't quite time it out perfectly, but I got within like 5% of the low or 2% of the low. I'm okay with that. If I get within a small percentage of the low, I'm perfectly happy with that because, again, I know it's a mindset. I'm going to be in that trade for a long, long time, months, years, maybe even decades, depending on how long that account's, getting
hopefully as long as possible. So,
yeah.
Absolutely, I love that. So it really is about switching gear. I mean, because I think a lot of people go into this, with the mindset of, I just want to be an investor. I just want to be a trader. Now, I think that also depends on capital, right? If you've only got $5,000 to your name, there's probably not a lot you can do. So you have to probably look at different vehicles. Or there's not a lot you can do in the investing world potentially, unless literally we're at the bottom of a major market crash, right? But
yeah, I mean, you could still do it on a $5,000 account. You're just not going to make much money, but it gives someone a start at least. Like for example,
but they could start that $5,000 in an income account with futures or Forex and potentially do better, couldn't they, Ryan, as well?
Sure, absolutely. And it gives them a great starting point. I mean, look at Forex. You can get started with Forex for a few $100, or a couple grand. I mean, there you go. There's your in right there.
Exactly. And
or
even
options.
I say that to anyone. And again, I'm not negative on crypto or anything, but again, pulling up the charts right now, just looking at this. Where are we? I know people are like throwing money, at the likes of Bitcoin and all of that. Let's just go over. I'm going to pull up the charts on here for you so you can see them. And this is exactly, look, this is what I'm talking about. You can buy micro bits of Bitcoin with a PayPal account right now. But again, look, highs of nearly 42,000. Here we are back down at 32,000 again. It's dangerous for people, I think, to be in those realms. And, while you can start small with the crypto, for years you've been able to start small with currency, Forex. I don't care. I got no faith in fiat currency, but heck, there's enough volume in it, right? I got no faith in the fact that Dizzy's going to keep going higher forever, but it doesn't mean I don't want to trade it or invest in it, right? It's just about price at the end of the day. And I think that's one of the great things you touch upon. It's all about saying, what are my goals? If I just want to literally put some money in, be very passive, get into the market at the right time, that's great. But if you want to be more active and literally more generate returns that you could maybe withdraw, then there's vehicles like futures and Forex and even options, right, that we could use as well. What I get really frustrated about is this, though, and I will say this, Ryan. I'm going to go back over to the SPY for just a second. And look, no one's going to argue with the fact that in the long term, and let's go over to a monthly chart here and let's just look at it last 20 years, right? No one's going to argue with the fact there that the market always goes up, right? But what irritates me is that people are like, well, you know, just buy and hold because in the long run, the market always goes up. That is a lie. The market doesn't always go up. It has gone up and is consistently gone higher. But there are long periods of time where it doesn't go up. There are long periods of time where that's happened. And for example, let's go back over to here. Let's look at a chart. I'm going to go over to, let's say this is a great example here on this weekly chart. This is this is 2014 to 2017. I would argue, and please give me, your opinion on it. That whole period there is pretty rangy, right, Ryan? You're up a bit, you're down a bit, you're up a bit. That's 3 years of your life. That's 3 years of where you've gone up, down, sideways, okay? So, you've got to weather the storm in that respect. You've got to look at basically especially if you were buying up here in those highs, you didn't get yourself into any real profit till here. So there's a lot of cost opportunity as well. I guess the question I have for you now is, is that a sign of when to switch the investing hat off and maybe take advantage of those conditions? Because I guess also if you bought it much, much lower, you're not going to worry about that. But it doesn't mean you're going to just sit on your hands and go, well, I'll just sit through that for 3 years and make no money. Are there things that an investor can do to still buy and hold their positions, but also make money when it's doing something sideways for a number of years as well?
Absolutely, and that's one of the benefits of switching gears, like you're saying, is I think that it's hard for me to tell the dates, but I think it's basically if you go from about November 2007 to February 2009.
Yeah.
It was a 50%, 51% drawdown. That's half.
Right.
That's half of someone's account right there. Just wipe off half.
Yeah.
So if you retired in December of 2007, you just lost half. Half.
That's a lot.
And then in January you're going right back to work again.
Well, here we are.
That's just not going to work. Yeah, there it is, right there.
Right there.
So that's 50%, 51% decline right there. And what a lot of people don't talk about is it takes about 4 or 5 years to get back to that same level. That's 5 years that you had to wait. But it's more than that, because that's just the time that it took for price to get back up to the highs. But if you have a 50% decline, my goodness, you need, 100% return just to get back to break even?
Yeah, exactly.
I mean, whoa. You're not going to get that in mutual funds. You're not going to get that in passive investing. And so
a lot of these newsletters will say otherwise, though, won't they? They'll turn and go, well, if you pick another Amazon, or we'll help you find the next Netflix, we'll help you find the next Tesla. Yeah, great, but you know what? Again, people turn and say, you never know, in 7 years from now, you could be... Some people say, I don't have freaking 7 years. I need to start doing it now,
Right.
Tell the guy who's 65, oh yeah, wait another 7 years, right? There's got to be other ways, I think. And that's what gets to me. Now, I've always been of the mantra of, if you have movement, you have opportunity, right? If there's movement... there's opportunity. I think that's all we really need. Would you agree on that, Ryan? That as long as
I would. In a situation like this, there's many trading opportunities. And I don't mean like even for someone that doesn't want to trade a lot or be a day trader, swing trader. They can do some longer term trading, might last weeks or months, but it's still trading. They're still being fairly proactive and active in their asset management. And you get a situation like that, you're able to see these markets turn, as they're going higher and higher, and they turn and roll over. When they roll over, like, hey, this market's coming down. Let me shift gears here. Let me sell off some of the equities that I have in my long-term accounts, or maybe, switch to bonds or cash or whatever, just get more defensive, in other words, and now start focusing on trading to the downside so that at least you can make money when price is going down. We call that shorting for people that don't know. When you get in a short position, you're able to take advantage and make money as prices are going down. So there's a lot of things that we can do, but if you're just a sit back at home passive investor and you don't even open your statements, or rarely do because you don't understand them, and they make them that way on purpose so that you don't understand it easily, then it makes it hard to stay engaged in the markets. But when you are engaged in the markets, then you're going to see things like that. You're going to see the top pattern crest over and roll down. Just like when the bottom comes, you're going to see it start to turn and head up higher. And then you can say, okay, here, the turn's coming. Now let me go back in, full asset allocation on the equities right there, and go for it and get that nice big run up, because you're going to hold that for the next 5, 10, whatever amount of years, and you're getting a much more efficient use of your money. And there's a lot of simple things that we as traders can do. I mean, even if you, okay, this is one of the most simplest, most ridiculously simple things an investor can do. Here's a free one for you guys, okay? Let's say you compare the S&P 500 and you just a straight buy and hold, okay? And you're going to get whatever you get. It's like around 10% or so. If you go back, several decades, you get it around 10%. Problem with that is you're getting up to a 50% drawdown. You get a 50% haircut in your account. Nobody wants that. If
Absolutely.
all you did was just say, when price crosses the 10-month moving average, your drawdown is only 15%, and now you're outperforming the S&P. So you're going to get outperformance with significantly less drawdown, and that's just one of the most simplest no-brainer things that an investor can do. And there's pros and cons to that, but I love the simplicity of something like that. And for I think a large population of investors out there, that really solves a lot of problems for them.
Yeah.
Especially someone that needs to be more defensive, that's retiring sometime soon. Within 10, 15 years, if you're retiring around 10, 15 years, you got to do something.
Sure.
Because you got to make sure that your money's going to be there when you do retire.
Exactly. And also, I think people overlook. I love that, Ryan. Thank you for sharing. I think also people overlook, and it's another thing I'd like to go on is, they do make the assumption that markets always go up. There's an old saying, history repeats itself, right? We've all heard of it. Yeah. Take a look at this. I just thought I'd bring this chart up here. Here's the Nikkei 225 index, a 67-year historical chart. This is the price action I've shown you here of the Nikkei, just so I can zoom in from 1980 into the end of 2020. I would argue that we had a pretty long-term bear market for, what have we got there, 25 years? And we've only just been in a bull market for the last 10? That's a 25, 30 year, almost 25, nearly 30 year.
Wow.
Let's go. It's 25-year bear market. And you know what? The interesting, scary thing about that is the economic policy around that time is very similar to the economic policy globally right now of low interest rates and printing money. And here we are right now. And I always say that to people, what if we go into that? What if people do lose their faith in stocks? I know companies can still operate, but what if? What do you do then? You have to have a different tactic, right? You have to. Yeah. And I pray that doesn't happen to the world again. But could it? That's the thing I always say. As an investor and trader, I always say, if it's happened before, it could happen again, right?
It will happen again. It's only a matter of time.
It is.
It's only a matter of time.
Feels,
at some point, it's going to happen.
To
some country, and I hope it's not us. But
I know. But it's always going to be an impact. We live in this global economy, I think, more than ever now. So there's always a chance of it. Ryan, great conversation. So, I mean, it comes down to having a plan, having a peruse, and being able to read the market as well, knowing the difference between a trader and investor. You've got a webinar tonight, haven't you? And I think also next Thursday coming up. I'll share the details. Want to tell us a little bit about what you're planning on talking about?
Yeah, sure. So, really, we're talking about how to defend yourself against an economic crisis. So good timing there, right?
Yeah.
We'll talk about different ways of doing that. We'll talk about a little history of the economic crisis and market crisis that have happened over the years and how to defend ourselves against it. And then really also how to take advantage of that, how to prosper, how to make money in those kind of environments, in those situations. Like you just showed the chart of the Nikkei. How do we prosper in that? How do we take advantage of situations like that? I think it's a very, very important topic that everyone needs to know because, again, it's only a matter of time before these things happen. I mean, who would have thought COVID, and bam, here we are. Who would have thought subprime crisis in 2008? And yet, bam, there we were, So, these things happen, and it always seems to catch people off guard, and they only learn about it, why and what happened after the fact. But we got to be prepared. And as traders, that gives us the ability to be significantly more prepared and ready to defend our capital as well as to take advantage of it and increase our capital.
Well, If you are interested in finding going to that complimentary webinar, I encourage you to go to stockability.com. On the homepage, scroll down to the bottom of that. You can see right here at the moment, and there's 3 familiar faces. But here's the information on here right now. Our complimentary webinar, The Crisis Proof Business. This is what it is here right now. Ryan will actually be tonight, Thursday, 21st of January at 7 p.m. Eastern. If you're on the West Coast, 4 p.m. Pacific. And if you're joining us or listening from Europe or somewhere else on board and say, hey, that's really not a great time, we have another one Tuesday of next week, which is the 26th of January, which is at 12 p.m. Eastern. Same topics, same content as well, just a little bit more of a different time there for you guys to be able to enjoy that as well. Go ahead and click on the register today button. You can hopefully get in time for that, and we'd love to see you there as well. So looking forward to that. What's on the cards, Ryan, for the rest of your day, my friend? Tell me a little bit about that.
Yeah, so I'm also teaching today, in fact, right before the webinar, the Income Abilities course, and that's the one. And this will be a fun day for them because we get into the actual strategies that we teach.
Nice.
So we've gone through all the prep work and all the foundations of it and all that type of stuff, and now we get into the real meat on the bone type of stuff. So they're excited about it, and I'm excited to teach it too. I think they'll have fun with it.
How rules based and like process driven do you keep it, Ryan, when you're doing that kind of stuff?
It is rules based. It is process driven. We actually use a system, and within that system we have several strategies, and it's quite simplistic. Let me put it this way: there's 3 rules. That's it. Step 1, step 2, step 3, trade.
Done.
That's how we keep it. It's like my cooking. If I keep it to 3 to 5 ingredients, it'll turn out pretty good normally.
Good.
It'll at least be edible. Let me put it that way.
Good man.
If I go more than 5 ingredients, it's not going to be edible.
I
pretty much guarantee you that.
So
we keep it real simple and straightforward so that anybody can understand what it is that we're trying to do.
Being able to make a decision is the most important thing as well.
Yeah.
Well, Ryan, I wish you best of luck with that as well. Have a
Thank
great
you.
webinar tonight as well. I'm sure a lot of people will be looking forward to hearing you from that. Always a pleasure having you on the show and your insights. Love to have you on the show in a couple of weeks again. Okay, my friend?
Thank you, Sam. Thanks for having me.
Enjoy the rest of your week. Thank you, sir.
Thanks. You too. Bye-bye.
Guys, that was Ryan Watkins of stockability.com, lead coach, mentor there as well, talking a little bit about the difference of knowing when to be a trader and investor. And guys, market conditions, they change. They don't always stay the same, and we have to be aware of those changes as they happen. And making those decisions when they happen is a key skill to develop as well. I've always said the world of trading and investing is definitely something that starts with knowledge and education, and is all about developing the skill as well. Just if you missed that before as well, these are the details on the webinar that's coming up tonight at 7 p.m. Eastern, so you've got plenty of time to join us for that, if that's great, if that works out well for you as well. 2 coming up on here right now. So first we've got our webinar on here, Thursday the 21st of January, which is today, if you didn't realize it. We've got that opportunity for you guys to come on to that one. Love to see you on that one on there. If that one doesn't work out for you guys, we've also got one coming up at 12 p.m. Eastern on Tuesday of next week. Both are going to be with Ryan Watkins and Daniel Bustamante, lead coaches, head coaches at stockability.com. Love to see you there and show a little bit about how we're preparing and what we do, and a little bit more of what we get up to in the live coaching community as well. Let's go to stockability.com, scroll down to the bottom of the homepage, guys, and all the information you need will be there as well. Well, that, guys, for me pretty much wraps up another week of us being here on the show as well. It's been a great show, another fun show. I'm going to thank you for joining us live if you did have that opportunity as well, and being a loyal follower of the show as well. We're growing all the time as well. If you are looking at this as a recording as well, hopefully you look at this in time to join us on one of those complimentary webinars too. Make sure you type your questions on the Facebook Live page or on the YouTube channel as well. Plenty more content coming to you in the coming weeks as well, as we keep taking things up a notch going into 2021, making this the best year we can, making the best of the situation as well. Guys, in the meantime, until I see you next week, stay safe, use those stop losses, manage the risk, always do process over profit, and I'm sure you'll be on the right side of the market. I've been Sam Evans. This has been Take Stock Live, brought to you by stockability.com. Have a great rest of your week, and I'll see you guys next time. Thank you.